Well, hello and welcome back to Principles of Accounting 1. I am your host, Dr. B. Today we're going to talk about accounts receivables and other receivables, like notes receivable and interest receivable, other receivables. There's a lot of different types of receivables we're going to talk about today. But before we jump into that conversation, I do want to quickly highlight where we are in the classroom. We are in the fall 2022 semester. This is an 8-week course. We made it all the way to module 3. Wow, holy smokes, week 5. Yeah, that's where we are right now. Now we're in chapter 9, which talks about receivables. But before we jump into that chapter, I do want to recap where we were. How did we get to where we are today? So last week, which was week 4, you had your chapter 7 quiz, your chapter 8 discussion board, and the midterm exam. Okay. The midterm exam covered everything from chapters 1 through 8. It was 10 questions worth 15 total points, which was 1.5 points per question. Uh, and it went okay. It could have been better, yeah. And I think you would all agree with that statement that it could have went a little better. It was open book, open note, and we did discuss the midterm exam before you all took it. Yes, it was challenging. I agree, it was challenging. There's no question. It was designed that way for a reason. I want to also call your attention to this other item right here. It says mid semester survey. This is a survey that I developed, and this survey is worth bonus points. Okay, it is worth bonus points. If you're not happy with your midterm grade or your grade so far in the course, please take the mid-semester survey. This survey, it's a couple of questions. They're all open-ended. Okay, there's 5 questions. I want you to tell me, through your experience in the course so far, by answering these 5 questions. I know several of you have already done this, and I appreciate you doing this. Each question, yeah, it's worth 5 points, okay? Each question is worth 1 point. So 5 points total. It's extra credit points. It's due today. It has a due date of today. Yeah, it's due tonight. My recommendation is to complete this survey for your bonus points. What I'll do is tomorrow, starting tomorrow, I will add the bonus points to your midterm exam score. Okay, that's how it works. That's how the grade book recognizes the extra credits, yeah? So please take that survey. It helps me and it helps you. Okay, bonus points. Yay, yeah, bonus points. So please do it. If you haven't done it, if you've done it already, thank you. If you haven't done it yet, please consider doing it. It will help you. It'll help me. So thank you. Okay, and you'll be able to find that right underneath where you took the midterm exam under week 4. So here we are, week 5. Let's talk about accounts receivables and all the different kinds of receivables. As always, if you have questions, comments, or concerns along the way as we're talking about these topics, please feel free to unmute your microphone and ask your question, or you're also more than welcome to type it into the chat, whichever you feel comfortable with. Okay, receivables. As you know, the word receivables means monies that is owed to the company. Monies that is owed to the company. We expect to receive monies from our customers that have not yet paid us. That's called accounts receivable. We expect to receive monies from our customers that have, where their accounts receivable has converted to a note receivable. We'll talk about that. or monies that we expect to receive from things like interest or some other reason why we might be receiving monies that we expect. So there's a few different types of accounts receivable, and that's what we're going to talk about today. So, as you know, sometimes customers will purchase goods and services on account from us, the company. When they purchase on account, that means they're using accounts receivable for us, yes? We sell the goods and services to the customer, we deliver, that creates an accounts receivable because the customer has not yet paid us. They owe us money for goods and services we have already provided to them. That's accounts receivable. Okay. We, as a company, have a method of valuing the accounts receivable. Okay. We keep all of our customers separate. All of their accounts receivable separate. I got a lot of customers, and a lot of them owe me money from goods and services I provided to them already. So their individual accounts make up the total of accounts receivable. I add up all my customers and what they owe me. That gives me the total accounts receivable. That's what we see on the balance sheet. As you know, accounts receivable is a current asset account on the balance sheet. And I can express that balance as a percentage of my total assets. And the way this works is I take my total accounts receivable and I divide that by my total assets. Total assets is all of my current assets accounts and all of my long-term or fixed asset accounts. I add all of my asset accounts. That's my total assets. So the formula to get the percentage of accounts receivable is I take total accounts receivable divided by total assets. Total accounts receivable divided by total assets. That gives me the percentage of total assets. Okay, and that's what we see in this example here. We see that for John Deere Company, their total accounts receivable was $3,000,000.011 for their accounts receivable, which is equivalent to 5.2% of their total assets. For the Callaway Golf Company, 16% of their total assets is in accounts receivable. For Pfizer, it's 4.8% of their accounts receivable is of their total assets. So, in other words, 4.8% equals 4.8% of their total assets is in accounts receivable. 4.1% for Abercrombie and Fitch. I could keep going on and on. But we see these companies that represent different sectors of the market, and we see Callaway Golf, 16%. That's huge. That's a lot of their funds tied up in accounts receivable. So as an investor, that makes me very weary of Callaway Golf because when I see a percentage that high in accounts receivable, it tells me that the company might not be that good when it comes to collecting their accounts receivable. Now, we're going to roll through a couple of examples, okay, of accounts receivable. Some of these might look familiar because I think we've gone through similar examples before. But I want to help you to understand accounts receivable from a records recording perspective. So here we have an example. On July 1, our company had credit sales, meaning we sold on accounts receivable, of $950 to our customer comp store. And on the same day, we've also collected from a different customer $720 from a prior sale. So these are two separate transactions. To record the first transaction of the sale of whatever it was that we sold on account to our customer, we debit accounts receivable and we credit sales. $950, $950. Debit accounts receivable to increase the accounts receivable, and we credit sales to increase our sales. Accounts receivable, as you know, is an asset account, and sales is an equity account. So the accounting equation is in balance. Remember, the accounting equation is assets equals liabilities plus equity. Assets went up by $950. Equity went up by $950. The accounting equation is in balance. There's no liability here. That part would be zero. Also on July 1st, we had a separate transaction where we collected cash from a different customer based off of a prior sale. So we debit cash to increase cash, and we credit the account receivable for that particular customer to decrease their account receivable. So that's why you see that dash and it has the customer's name, RDA Electronics. And then even in the first transaction, you see accounts receivable dash comp store. Every customer who purchases on account or on credit has their own account receivable account. As I had mentioned earlier, we add up all of our individual customers who owe us to get the total accounts receivable. That's what you see on the balance sheet. So again, separate second transaction, we increased cash by debiting cash, $720, and we decreased that customer's account receivable by crediting accounts receivable, $720. Make sense so far? All right, good.
Yep.
Awesome. Thank you, John. So we recorded those transactions. I want to show you what it looks like on the ledger accounts. As you learned from previous chapters about how the general ledger works, the general ledger represents the balance from the transactions. Okay? The general ledger for accounts receivable on the left represents the balance for accounts receivable based off of the individual transactions. We started or ended the month of June with $3,000 balance. The accounts receivable went up by $950 based off of a sale that we made on July 1. And then it went down by $720 based off of a collection of payment from a customer, also on July 1, giving us an ending balance for July 1st of $3,230. So on our total accounts receivable, we see $3,230. We have other ledgers, of course, that are impacted, and these are the individual customer accounts receivable ledgers. Think of these as the subsidiary ledgers for accounts receivable. As you recall, a subsidiary ledger are the individual ledgers within the general ledger for that account. So on the right-hand side, you see the subsidiary accounts. These are the individual customer accounts within accounts receivable. And you can see how those balances translate into accounts receivable. Oh, let's talk about other kinds of receivables. Okay, this one is interesting. And I talked slightly about this in the past. Okay, the store credit card. Different than a regular credit card, right? Sometimes you might have a store credit card. It doesn't have the Visa or the MasterCard or the Discover or whatever's. Okay, it doesn't have that part. It's just the store card. I used to have a Macy's one. Yeah, I used to have a Macy's one. It just had Macy's on it. It didn't say Visa, MasterCard, Discover, none of that stuff. It just said Macy's, okay? And it had a number, it had an account number on it. That's called a store card. You might have one from Best Buy. You might have one from, you know, Macy's. You might have one from whatever your favorite stores that you like to shop at. It's a store. It's basically a store credit card. It can only be used at that store. It can't be used anywhere else. Okay? You can't take money out of it. You can't do nothing else with it. You'd only use it for purchases at that store. Okay? That's called a store credit card. Store credit cards are different than regular credit cards. A store credit card can only be used at the store. The store credit card is treated as an accounts receivable. Okay? A regular credit card is treated as cash. A regular credit card is treated as cash. A store credit card is treated as accounts receivable because it can only be used at that store. So, let's say Dr. B uses his Macy's store card at Macy's, goes to Macy's, purchases $1,000 worth of clothing. I would never do this, but I might, okay? So I swipe my store card at the Macy's. Macy's treats that transaction as accounts receivable. It would say accounts receivable, the dash, Dr. B would be the debit and the credit would be sales. If I don't pay that credit card right away, I will accrue interest. Okay? I personally I pay right away because I don't like paying, interest to banks, yeah, or to anyone else. But some people don't pay right away. So they accrue interest every month that the balance is not paid. Yeah? The interest is 1.5%. That's funny. We know it's probably like 500%, but it's actually 1.5% in this example. So let's say I don't pay it, let that $1,000 go. I'll pay them later. Yeah. Well, if I pay them later, meaning I, don't pay them in November, maybe I didn't pay them in December, they add on interest for not paying them. Yes. The interest is 1.5% per month, probably per day in real life. So there's a new receivable. Well, they debit account receivable Dr. B, $15. Okay. because I owe them an additional $15 based off the 1.5% interest because I didn't pay them for 2 months. And they credit interest revenue, $15. Interest revenue is an account where they're receiving revenue based off of the interest that is accrued. Even if I don't pay them, they still recognize revenue that they earned based off of me not paying them. It's called interest revenue. So, to recap, debit accounts receivable, 15 for Dr. B, $15. That increases what I owe Macy's by $15. And they credit interest revenue, $15, because the store is earning revenue based off of the interest on the money that I owe them of $15. Makes sense so far? Good. Yeah. Okay.
Yes.
Awesome. Thank you so much. Okay. Now, let's say we got a customer that instead of using their store card with us, they use their bank credit card. It's a Visa, it's a MasterCard, it's a Discover, whatever. So they come in with their store card. I'm sorry, their regular credit card, yeah? The Visa, the MasterCard, the Discover. They swipe the credit card at the terminal, okay, at the time of the purchase. Now, here's the thing. Sometimes you might go to a store, and that store might charge you more if you use your credit card. They might say, you know what, we're going to have to add on 4% to your total if you use a credit card. And sometimes you might be wondering, well, why the hell is the store doing this to me? I'm just trying to pay for my stuff. I don't want to pay more. They're doing it for this reason. Every time a credit card is swiped somewhere, anywhere, I don't care where it is, the credit card company, Visa, Discover, MasterCard, whatever, charges the store, the owner, a fee. And it's usually a percentage of the sale. In this example, it's 4%. It's probably higher. It might be around the same these days, actually. It's probably about 4%. So what that means is the store doesn't actually get the whole $100. They only get 96 out of the 100. 4% of that $100 goes to the fee that the store has to pay because you use your credit card at the store. Ain't that a kicker? But that's why sometimes when you go to the store, you might see, oh, they're charging me an extra 4% because I'm using my credit card. That's why also sometimes you'll go to a gas station and they'll have a different price for cash and a different price for credit card. It's because of this reason. Yeah? It's because the gas station doesn't want to pay that 4%, so they're going to pass that cost along to you. Yeah? That's why there's a difference. So, here we have an example. Customer comes in, they use their Visa card to purchase $100 worth of stuff from us. No problem. The way I record this transaction is I debit cash $96. The reason why $96 is because I have to pay 4% of that $100 in fees. We call that account credit card expense. It's an expense account that shows up on your income statement. Okay? So we debit cash, $96. Why? 96 is 96% of 100. 96, that's how we got 96. We debit credit card expense, $4, because that's 4% of 100, yes? And we credit sales $100, because I made the sale for $100. I collected 96 of that 100 from the credit card company. The other $4 they kept as a credit card fee. So that's why we see these types of transactions. So debit cash, 96 to increase our cash. Debit credit card expense to increase our expense by $4. And we credit sales, $100 to increase our sales by 100. So that's a transaction using a bank credit card. Sometimes we might sell a product on installment. On installment. This is very common with large items. Okay. For example, the washing machine breaks. Oh, God forbid. Man, that's a big bill. All right. Washing machine goes down, takes a dive. Okay. Washing machine done. Okay. Now I got to go get another washing machine. So I go to the appliance store. They say, "Oh, Dr. B, you need to buy a new washing machine." Well, that's going to cost you $1,000. I ain't got $1,000 in my bank account. Okay. They say, "No problem. You can pay us on installments." Okay. It's a fancy way of saying us, "Hey, we'll finance it for you." So I go to the store. They say, "Hey, that new machine you want, that's $1,000." And I say, "I don't have $1,000." They say, "Okay, no problem. You can pay us over time. You can pay us $112 a month for a year." And I'm going in my head and saying, "Wait a second, that doesn't equal 1,000. 112 over a year is way more than 1,000. What are you guys trying to do with it?" Is what I tell them. And they say, "Well, we got to charge you interest, if you want to pay us on the monthly installments." That's what installments are. So it's amounts owed by the customer from the credit sale, where payments are made periodically over an extended period of time. The customer is usually charged interest. It's a fancy way of the store financing the purchase. That's what installments are. Okay. Now, there's a couple of things in business that you'll learn. One of the toughest lessons that I ever learned in business was that not all customers pay. Oh, I know. Not all customers pay. Oh, it's terrible, isn't it? So that happens from time to time. Sometimes the customer dies. They fall off the face of the planet. You can't reach them. They gave you a bad number. They won't answer your calls. They won't answer your emails, your letters. You're trying to collect from them. They ain't there. You send your cousin Vinny over to convince them to pay you. Cousin Vinny can't find them. They give you a bad address. Okay. Ooh, hurts my heart every time. So what we do is this method called the direct write-off method for accounts receivable. We use this method when our customer won't pay us or can't pay us or won't pay us. We can't collect from them for whatever reason. So we use what's called the direct write-off method for the accounts receivable. So some customers might not pay us, okay? We can't collect You can't collect on them. When this happens, it's called a bad debt. A bad debt. A bad debt simply means we can't collect it. It's a bad debt. So there's two methods to writing off this bad debt. Because if I can't collect it, I'm not going to leave it on my accounts receivable. If I can't collect something, I'm not just going to leave it on accounts receivable saying, oh, I bet maybe they'll come back. No, they ain't coming back. Okay, so there's two methods to writing off the bad debt. One's called the direct write-off method, and the other one is called the allowance method. Companies usually select one or the other. Small companies usually use the direct write-off method because it's easy. It's very simple to track who didn't pay you, okay, and we can write it off. The allowance method is a little bit more complex. With the allowance method, we basically take a percentage of all of our accounts receivable that we think we're not going to be able to collect. It's kind of like an estimate, yeah? That's why we call it an allowance. We are going to allow that 5% of our customers won't ever pay us back what they owe us for the accounts receivable. That's called the allowance method. We'll talk about both of them. So direct write-off. I got a customer, Jay Kent. This guy disappeared off the face of the planet. Don't know what happened to him. He owes me $520. Okay, I sent letter after letter, past due, past due. You know, the invoices, past due, past due. It went unanswered. I started calling the customer. Hey, you owe me $520. Then all of a sudden I get the busy noise, disconnected, line no longer in service message. Yeah. Sending emails, bounces back, deliverable. Okay. Then I send Cousin Vinny to his address. Cousin Vinny says, can't find the guy. Okay. So, in this situation, I've decided I need to write it off. Now, the company takes a loss, right? I can't collect the $520. I sold the stuff to the guy. I can't collect it. Okay, it's a bad debt. So I lose out on $520. Yeah, mostly. But I can write it off. When I write something off, what I'm doing is I'm taking it out of accounts receivable because I can't collect it, the guy's not there. And I'm putting it into bad debt expense. Bad debt expense is an expense account that shows up on your income statement. Now, you already know that expenses will reduce your net income. The more expenses you have, the lower your net income is going to be. Okay? And what this does is it reduces the company's taxable income. That's why we call it write-off. And that's where the word write-off comes from. It reduces the company's taxable income. And so, in order for me to write off this bad debt, I debit bad debt expense, $520. And I credit accounts receivable for that customer, $520, because I can't collect it. Makes sense? Good so far.
Yes.
Awesome. Thank you, Christian. If you guys find Jay Kent, let him know he owes me money. I'm kidding, of course. Okay. Now, someone found Jay Kent. I don't know who it was, but thank you. Thank you for finding Jay Kent. So he shows up one day. Okay, he shows up to my store. And he goes, "Oh, Dr. B, I'm so sorry. I know. I think you've been trying to reach me." You think, Jay Kent? It's been months, dude. So he shows up randomly the following year. Because this was back January 23rd. I had to write this guy off. 3 months later, he shows up, March 11th. Shows up at my door. Hey, I'm so sorry. I don't know what happened. I must have forgot. Uh-huh. Sure you did. I sent you multiple letters, phone calls, emails. Sent a guy to your house. Okay, so he shows up. I got the $520 I owe you. So here's what we do when something like miraculous like that happens. First thing we do, we have to make an reversing entry. Adjusting reverse. We have to make a reversing entry. Okay? The way that we do that is we debit the account receivable. We're reinstating the account receivable that we wrote off earlier. Debit the account receivable for that customer. And we credit bad debt expense. We have to remove that bad debt expense for that customer because he showed up. So that's the first transaction. Debit account receivable, $520. I'm reinstating the account receivable. Credit bad debt expense, reduce that bad debt expense by the same amount that we wrote off earlier. And what that does is it reinstates the previous account and reverses the write-off. The second transaction I make is I debit cash $520 because I'm receiving the $520 from J. Kent. And I credit the account receivable to then reduce that same account receivable by the $520. Record the full payment. Took a while, finally got the guy. Unbelievable. But yeah, this type of stuff happens. Unfortunately, it happens more than small business owners like to admit, but it does happen. So when you decide to use the direct write-off method, we go through the expense recognition principle, which requires the expenses to be reported in the same accounting period as sales they help produce. Fancy talk for saying, when there's a bad debt expense, you have to make sure that you record it in the same year that that bad debt expense occurred. Okay. So for Jay Kent's situation, for example, let's say that guy never showed up. Okay, he never showed up. By December 31, I would have had to make sure that that bad debt expense existed. Yeah, because that sale occurred in January. By December 31, if he never paid me, I'd have to do the bad debt expense. Mm-hmm. So expense recognition has to happen in the same time period that the sale happened. And the other thing you need to make sure is that the results would be similar as if you use the allowance method. We haven't talked about the allowance method yet, but we're going to talk about that here soon. And these are the two things that need to be true in order for the direct write-off method to work. So now let's talk about that allowance method. You know about the direct write-off method, now let's talk about the allowance method. As I mentioned, the allowance method is an estimate that bad debt is going to happen to us. Okay? Yeah, it's an estimate that, maybe 5% of my customers will never pay us for their accounts receivable. Yeah, that happens. So we have to estimate that 5% is going to be uncollectible. So at the end of each accounting period, we estimate our bad debts that we're not going to be able to collect. I estimate that I'm not going to be able to collect 5% of my total accounts receivable at the end of each year. That number might change from year to year. It's an estimate. So there's two advantages to using this estimate. One is that we record the estimated bad debt expense at the end of the accounting period related to the sales. You know? And the second advantage is accounts receivable on the balance sheet is at the estimated amount of cash to be collected. In other words, the balance of accounts receivable on the balance sheet is what I expect to collect based off of my 5% estimate that I won't be able to collect. So in other words, at the end of the year, I reduce my accounts receivable by that 5% with the expectation I'm not going to be able to collect 5%. So let me show you an example. Our company for the year has $300,000 of sales, of credit sales, sales I made on account. Yeah. At the end of the first year, I was unable to collect $20,000. Out of 300,000, 20,000 is a lot. It's still there. Based on that experience, we can estimate that for every year, or at least for this year, out of that remaining 20,000, I'm probably not going to be able to collect $1,500 worth. It's an estimate, right? I'm estimating that I'm not going to be able to collect $1,500 worth of my accounts receivable. You know, those customers are they're just not going to pay us. It's an estimate. So, in order to record this estimate, I debit bad debt expense and I credit a new account. It's called allowance for doubtful accounts. Allowance for doubtful accounts. This is a new account. You probably haven't heard this one before. The allowance for doubtful accounts is a contra account. Contra account. We've talked briefly about contra accounts in the past. A contra account holds a credit balance and it is an asset account. A contra account holds a credit balance and it is an asset account. What I mean by this is the allowance for doubtful accounts is an asset account and it normally holds a credit balance, which is the opposite contra of normal asset accounts. It is contra to accounts receivable. So on the balance sheet, you might see allowance for doubtful accounts under assets, and it has a negative balance. It has a negative balance because it is contra to accounts receivable. So again, it's an asset, yeah, and it's a contra account. So in order for accounts receivable to reflect the estimated collectible amount, we contra accounts receivable. So accounts receivable minus the allowance for doubtful accounts gives us the amount of accounts receivable we expect to collect. That's what this shows us. Writing off a bad debt. using the allowance method. Now, let's say we use the allowance method instead of the direct write-off method. If we use the allowance method and we have our customer, J. Ken, who has not paid us what he owes us, we can write off that amount using the allowance method. And the way that we do that is we debit allowance for doubtful accounts to reduce the allowance for doubtful accounts. And we credit accounts receivable to reduce the accounts receivable. What we're doing there is we're only affecting two asset accounts. One normally holds a negative balance, which is the allowance for doubtful accounts. The other one normally holds positive balance, which is accounts receivable. So all we're doing is we're saying, yeah, JCAT's not going to pay us, so we take it out of allowance for doubtful accounts and we reduce the accounts receivable. This is how we write off on the uncollectible accounts receivable using the allowance method. It's important to note that for either method you use, whether you use the direct write-off method or the allowance method for writing off bad debt, the write-off does not affect the realizable value of accounts receivable. What I mean by that is because allowance for doubtful accounts is a contra account, and because the direct write-off method is direct, neither of those methods has an impact on the realizable value of accounts receivable. So, as we can see, before we wrote off J. Kent's bad debt, we had accounts receivable of $20,000 and allowance for doubtful accounts $1,500, giving us a balance of $18,500. After we wrote off the bad debt, our accounts receivable dropped to $19,480. Our allowance for doubtful accounts dropped to $980, giving us the net realizable value of accounts receivable, $18,500. So again, either method of writing off a bad debt does not affect the net realizable value of accounts receivable. Now let's say that J. Kent shows up. All right, he shows up with the money that he owes us after we wrote it off. Of course, that's always when it happens, right? He shows up. So J. Kent shows up. We need to restore the credit standing for J. Kent and recognize the payment. So the way that we do that is very similar to the direct write-off method. We debit accounts receivable $520. We credit the allowance for doubtful accounts $520 to reinstate the previous write-off. Then we debit cash $520 because we're receiving the cash from the customer, and we credit the accounts receivable to reduce the accounts receivable for the customer by $520. Now, when we estimate the allowance for doubtful accounts, sometimes that estimate can either be fixed number, like in the previous example with the $1,500, or it can be based on sales. When it's based on sales, we typically apply a percentage of sales that we expect not to be able to collect. Typically. So Percentage of sales method, it might be, in my earlier example, 5% of sales I'm not going to be able to collect. It happens, yeah? That's a good estimate. Or I could use what's called the accounts receivable methods. I can either use a percentage of accounts receivable, or I can use the aging report for accounts receivable. Now I'm going to show you these 4 items. First, let's start with the percentage of sales method. Using the percentage of sales, I take the current period sales. This would be total revenue, yeah? For the year, we'll say. Times the bad debt percentage. This percentage, again, is an estimate, and in my example, I'll use 5% as my estimate that I won't be able to collect. That will give me the estimated bad debt expense. This company is going to use an example, or it's going to be 0.6% that they're not going to be able to collect. So we have a company, Musicland, they sell pianos. It has credit sales of $400,000. It's estimated that 0.6% of the credit sales will not be collectible. So we take the $400,000 credit sales times 0.6% will give us estimated bad debt expense of $2,400. To record this estimated bad debt expense, we make an adjusting journal entry at the end of the year where we debit bad debt expense, $2,400, and we credit the allowance for doubtful accounts, $2,400. So, to compute the estimate for the allowance of doubtful accounts, year-end accounts receivable times the bad debt percentage. We take the total estimated bad debt expense minus the previous balance in allowance account, allowance for doubtful accounts, equals the bad debt expense. And this is for the percent receivables method. Sorry, I should have said that earlier. This one I showed you before was the percent of sales method. Now I'm showing you the percent of receivables method. Percent of receivables method, we take the year-end accounts receivable times bad debt percentage. To yield it, we take the total estimated bad debt expense minus the previous balance in the allowance for doubtful accounts equals the current bad debt expense. In our example, the company has $50,000 in accounts receivable and a $200 credit balance in the allowance for doubtful accounts. 5% of our receivables are going to be uncollectible. That's the estimate. Okay? So we take the $50,000, which is the accounts receivable balance, times the 5%. That should give us an ending balance of $2,500. But remember, we have a previous balance in the allowance for doubtful accounts. So we take our $2,500 ending balance minus the previous balance of $200 equals $2,300 that we expect we won't be able to collect. So at the end of the year, we make an adjusting entry. We Debit bad debt expense, 2,300. And we credit the allowance for doubtful accounts, 2,300. Now I showed you the method for sales. I showed you the method for accounts receivable. Now let me show you how we will collect an accounts receivable using the aging method. The aging method is based on the aging accounts receivable report. This accounts receivable report is an internal, which is a managerial accounting report that shows the managers of the company how aged the receivables are. In other words, it helps to classify each account receivable based on how long it is past due. The report for the aging receivables shows us how long it's been past due. Each group, we multiply it by the bad debt percentage, and we estimate the bad debt for each group using their totals. I'll show you how that works. This is called an aging report. It shows us how long each account receivable is past due. My heart breaks every time I see this thing, especially when I see over 90 days past due. Oh, that's painful. So here's how it works. We have all of our customer totals, yeah? And so we have categories. Not yet due. That means it's current. They're not overdue yet. So they're within their first 30 days, yeah? They haven't paid us in their first 30 days. It's not yet due. It's due net 30, right? Net 30. So I got 3 customers that are net 30. They have, it's not due yet. Total of $37,000. I'm going to estimate that I'm not going to be able to collect 2% of that 37,000. That gives me an estimated uncollectible amount of 740. I follow the same process for each category. 1 through 30 days past due. I estimate I'm not going to be able to collect 5% of this category. I got $6,500 worth of customers' accounts receivable that are 1 through 30 days past due. So 6,500 times 5%. I'm not going to be able to collect $325 of this category. 31 through 60. Ooh, we're getting there. That must be when I sent my second notice, right? 31 through 60. $3,700 of accounts receivable are outstanding. 31 through 60 days past due. I estimate I won't be able to collect about 10% of that balance. That's 370. 61 to 90. Oh my goodness. $1,900 outstanding. 25% of that I'm not going to be able to collect. Estimate, right? Gives me 475. 90 days plus. Oh man. There's a 40% chance I'm not going to be able to collect any of that. So $900 is 90 days plus past due. So 900 times the 40%, 360. I add up each category. 740 plus 325 plus 370 plus 475 plus 360 gives me a total estimated uncollectible amount of $2,270. So I make an adjusting enter. I debit bad debt expense, 2,070. I credit allowance for doubtful accounts, 2,070. You notice I make these adjusting entries at the end of each year. or the reason why it's 2,070 is because instead of 2,270 is because I had a current balance of $200. Okay. Yeah. Okay, the summary. So we have uh, this kind of summarizes all the different methods, right? So if I use percentage of sales, it's the sales times percentage I expect not to be able to collect, which is the rate, gives me the bad debt expense amount. Percent of accounts receivable, I take total accounts receivable times percentage I expect not to be able to collect, equals the allowance for doubtful accounts account. For aging, I take each accounts receivable by age times the individual rates equals the allowance for doubtful accounts for each uh, age range, and I add all those up to get the allowance for doubtful accounts. Okay, now that we have an understanding of doubtful accounts and bad debt expense, I want to switch gears a little bit to a new receivable that we haven't talked about. This is called a note receivable. A note, as you know, is a loan. Sometimes a customer won't pay us for a while. And when that happens, the company will negotiate with the customer. And the company might say, hey, customer, you haven't paid me. You billed 90 plus days out, if it's past due by 3 months. I see you're having trouble paying. So here's what I'm going to do for you, customer. Instead of it being an accounts receivable, we will convert your accounts receivable to what we call a note receivable. Now, what's happening here is I'm converting the customer's accounts receivable to a loan. The customer owes the company a loan, basically. And so they'll pay us over time, and we're going to tack on some interest, and the loan has a due date. So that's what a notes receivable is. It's the conversion of an accounts receivable to a note receivable that has a due date and some interest. The due date is called the maturity date. Here's how it looks. So the customer agrees. They say, okay, I know I'm 90 days past due. I agree for you to convert my past due amount into a note receivable and at an interest rate of 12%. I agree. So they sign what's called a promissory note. All of you probably signed a promissory note. Well, most of you probably signed a promissory note when you got your student loans. It's a promise to pay. Promissory note, that's why I call it that. Promissory note is a written promise to pay a specified amount of money, usually with interest, on demand or at a future stated date. So this is what a promissory note looks like. It has the principal balance, the original amount, the date of the note, the due date of the note, who it's being paid to, any interest rate, and who's paying it, the maker. Okay, so we can see that we had a customer, they were past due, we converted their accounts receivable to a note receivable. We said, hey, customer, you got 90 days to pay me the $1,000 that you owe me. In addition to the $1,000, you also owe me 12% interest over this 90 days. Customer agreed. So how did we come up with 90 days, you might ask? 90 days is the maturity date. Okay? Maturity date of a note is the day that the note and interest must be repaid. The due date is the same as the maturity date for a note. On July 10th, we receive a $1,000 90-day 12% promissory note from our customer as a result of a sale to Julia. She's past due. So we converted it to a promissory note. She signed the promissory note on July 10th. So we got to figure out when is this thing due. We received that July 10th. We got to figure out the due date. Well, to figure it out, we took the amount of days in July. There's 31 days in July. Minus 10 days because she didn't sign until July 10th. That means there's 21 days remaining in July. Plus all of August, 31 days. Plus all of September, 30 days. Plus 8 days in October. We got to get to 90 days. Remember, it's a 90-day note. Okay. So 90-day note tells us from July 10th, you go forward 90 days. That means that the note is due on October 8th. We got October 8th by taking all of what's left in July, all of August, all of September, plus a few days in October. You get to 90 days. It's a matter of looking at the calendar to figure it out. So how do we find how much interest we're going to receive from this note receivable? Well, we take this formula to find out how much interest we're going to earn from this note receivable. We take the principal balance, or principal amount, in this example, $1,000, times the interest rate, 12%, times what we call time. How long is the note forced? For 90 days. So we express that in a fraction. Here's how we do that. We take the 90 days divided by 360. 360. Now I can already hear you, Dr. B, there's 365 days in a year. Why 360? The reason why we do it in 360 days and not 365 days is because there are 360 banking days in a calendar year. Not 365, but 360 banking days in a calendar year. That's why 360 equals principal balance times 0.12, which is 12%, times 0.25, which is 90 over 360, equals $30 of interest is what we'll earn from this note receivable. Yeah. So if the annual interest rate is less than a year, the rate is annualized. So either way, it's an annualized interest rate, meaning the interest rate we use for the annual amount. The time, it's the amount of days that notice for in this example, 9 days, divided by 360 because there are 360 banking days in a year. Banking days. It's called the banker's rule. So to record the note receivable, we debit notes receivable, $1,000. That's the face value, also known as the principal balance or principal amount. Debit notes receivable, $1,000. Credit sales, $1,000. It's to record the original note. On October the 5th, okay, so this is a separate example. On October the 5th, we are receiving an agreement to accept some cash from a customer along with a conversion of an account receivable to a note receivable. So customer says, hey, I owe you $832. And we say, yeah, you owe us $832. You're past due. So we decided, hey, we're going to convert your account receivable to a note receivable. Customer says, yeah, I'll agree to that. They'll also pay us some cash up front. They're going to pay us $232 in cash up front, along with a converted note receivable of $600 for a 60-day note at a 15% interest rate. And this will settle the past due account. So to record this transaction, we debit the $232 that we received in cash to increase our cash. We debit a notes receivable, $600 to increase note receivable. And we credit the account receivable of $832 to satisfy the account receivable. Sometimes even the note doesn't get respected. In other words, sometimes they even don't pay the note received. That's called dishonoring a note receivable. First, we'll talk about a customer that respected the note receivable and paid it. Now we'll talk about a customer that didn't. So here we have the principal and interest of the note are due on the maturity date. The customer has a note receivable for $600, 15% interest rate at 60 days. So on December 4th, they're paying it. So we debit cash, $615. How $615? We have principal balance of $600 times 15% interest, so 0.15 times 60 over 360, 60 days over 360 banking days. That formula gets us to 615. So we debit cash, 615. We credit the note receivable, 600, to satisfy the note receivable. And we credit interest revenue, $15, because we're receiving $15 in interest from the note receivable. Now what about a customer that decided not to pay on time? We call this dishonoring the note. It does not relieve them of paying the note. They still owe the note. And they also owe the interest. So, what we decide to do in this situation is to revert the note back to an account receivable. And the way that we do that is we debit the account receivable for the customer. We credit the interest that we still expect to collect, $15. And we credit the note receivable to reduce the note receivable by the face value. What this does is it just discharges the note, but it still leaves the account receivable balance and it still leaves the interest. So at the end of the accounting period, we need to identify the interest that we expect to collect. And the way that we do that is we debit interest receivable. We expect to receive payment for the interest. And we credit interest revenue to recognize the increase in the revenue for interest. Now, at the end of the year, I might make some collections on interest and collections on notes. So we need to record this transaction. Here we have a $3,000 note at 12% interest rate for 60 days. I expect to collect $60 in interest. Well, at the end of the year, I need to identify what I've received. Yeah. So I debit cash $3,060 to represent the collection of this note. I credit interest revenue of 45. Why is that? Now here's the thing. This example went over into the next year. The agreement was made in December. It went into February. It's due in February, but it started in December. Okay? I need to recognize what has already been received as revenue in the month of December. Okay? So, and then January and February, because that's in a different accounting period, I need to identify that that's still receivable in that period, right? That's why we see them separated like this. So interest revenue, 45, interest receivable, 15. Of course, the two together equals 60. But they're separated out because, according to the matching principle, I need to identify when the interest was earned in that accounting period. That's why we see it separated like this. Sometimes I can collect before the maturity date. Sure, of course I can. There's nothing wrong with paying an individual paying early. In fact, I usually like that. Companies can convert receivables to cash before they are due. Isn't that nice? I collect it before it's actually due. Yeah, sometimes customers are nice like that. So Or also, and this one's a good one too. Sometimes a company might sell their receivables. You may have seen this. Hopefully you haven't, but maybe you've experienced it. A company might sell their accounts receivable to a debt collecting agency. Okay. You know, sometimes it makes sense for the company to do that. Let's say uh, you have a customer. It's been well over 90 days. You know they're not going to pay you. Okay. So you decide to sell the account receivable. You're not going to collect the whole amount. No, you're just not going to collect the whole amount. Okay. So the way it works is the company will reach out to a debt collection agency and say, hey, I got a customer. They're 90 days past due. I don't expect to hear from them. I've tried. So that collection agency will buy that account receivable from the company. The company likes it because they're going to receive cash from that debt collection agency. Okay, it's not the full amount, but they're still getting money in. That's why they do that. The debt collection agency will then try to go after that customer on behalf of the company, but it's really on behalf of the debt collection agency because the company sold the debt to the debt collection agency. Debt collection agency goes after the customer for the payment. So when that happens, company debits cash for the cash they collected from the debt agency for the bad debt, 19,200 in this example. The fee is called a factoring fee expense. Factoring fee expense simply means that this is the amount that the company uh, did not collect from the customer, and it's because the company sold the debt for $19,200 to the debt collection agency. The customer owed $20,000. The company got $19,200 from the debt collection agency. So the difference is $800, and they record this as a factoring fee expense. Another method is called pledging the receivables. What this means is that the company is going to basically secure the note receivable with a note payable. Okay. So they're basically taking out a loan to secure it. So they debit cash, credit, notes payable. That one's not as common. A couple of ratios. We can't leave without some ratios. One's called the accounts receivable turnover. This tells us how long it takes for customers to pay their account receivable to the company. On average, how long? We take sales divided by average accounts receivable. Average accounts receivable, we take the beginning balance accounts receivable plus the ending balance accounts receivable divided by 2. That, my friends, is our discussion on receivables. Any questions at all on receivables? No, you all good so far. Any questions at all on receivables? Awesome. Thank you, Christian. Okay, let's take a 5-minute break. Um, let's meet back here at 12:41. 5-minute break.